You definitely don't want to get it wrong with those guys.
Yeah.
Curiously, and this is really interesting, they know more about what you've earned and what you've spent than you do when you prepare your return.
You're listening to Property Investor Tales, stories from the front yard.
Hello and welcome to Property Investor Tales, stories from the front yard, where I get to speak to property investors from around Australia about their investing journey. My name's Tabitha Bright and I'm the head of coaching here at Positive Real Estate, where we help people build wealth through property. With over 8,000 clients across Australia and New Zealand, there are some incredible stories to tell, which hopefully make your investing journey that little bit easier and will inspire you along the way. So my guest today is Anthony Wolfenden from Positive Tax Solutions, a very important member of our 6-star team here at Positive Real Estate. And we discuss how to interact with your team of experts and save yourselves multiple dollars, why it's better to pay tax each year, no joke, and the most common mistake that people make working with an accountant. So a not to be missed conversation with Ant. Hi, and welcome to the podcast. Today, I'm super lucky. I've got my good friend Ant Wolfenden, Wolfie, another. I just found out he's known by his to his friends as Wolfie,
It's on the number plate.
And Ant is part of our 6-star team here at Positive Real Estate. So part of the valuable 6-star team, he's an extremely important part, him and his team, and because they are positive tax. And so for all of our clients that invest in property, positive tax is one of your first stops at the end of the financial year, because there's nothing more important as an investor than having a tax accountant that understands your goals and understands property investing. And I can talk from my own experience, because when I first started investing many, many years ago, I read all these books about these, about great things that you could do with your accounting, with your property investing. And I researched the forums and all of that kind of stuff. And I came across these great accountants that were recommended. And all the books said that I needed to set up in a company trust, I needed to protect my assets, et cetera, et cetera. So I went along armed with all this knowledge, sat with my accountant, who was an expert in setting people up for property investing. And I told him I needed a company trust structure. What type of company trust structure? I actually got set up with 2 types of company trust structures. One was a discretionary trust. I also had a hybrid trust. Oh, yeah. And I even got lending for it at the time. It was quite incredible. And the challenge was that I didn't go into it asking my expert for his advice on how to achieve an outcome. I went in telling him what I wanted without giving him the opportunity to take me through the pros and cons and the trade-offs of the decisions I was making. And so what that meant was that I was overstructured. I didn't have any need for those entities at that point of my investing. And I missed out with one of them in particular on a whole heap of depreciation and tax advantages, which meant my cash flow at the time was negative, whereas it could have been positive. And I didn't understand this because I went in telling my accountant, and it's something I see all the time with coaching. People will come in and tell me what they want and what they think they need to do, when they really need to be asking the question and telling people what is their outcome. So today I wanted to talk to Ant, because I'm sure with the multitude of clients that you look after that are all property investing, Ant, you must have had some lessons over the years in coaching and working with clients to get them a phenomenal tax and planning result. So great to have you here. Thank you for listening to the preamble. Welcome to the podcast, Ant.
I'm very, very glad to be here. Tax is a hot, important, and I think exciting topic. I want to be clear where I'm coming from because I want this to
Please.
resonate with some of the folks who've been listening. So I've been a property investor with my wife for 36 years.
Wow.
And
Yep.
we have taken extensive use of tax benefits and getting beat up a few times as well. I'm a tax financial advisor. So to be clear, I'm not the tax agent that actually is authorized to prepare the returns. I just happen to work in a tax business with some very good accountants. And so I have the perspective of someone who services clients and is a client myself.
Fantastic.
I guess one of the first things I'd suggest to clients is have an accountant. That's the very first thing I'd say. And there's a couple of reasons for that. This is my thought, certainly for me, having spoken to the tax office on a couple of occasions, it is my elected choice to never do so again.
Yeah.
And you have that ability if you have a tax agent. Your tax agent can represent you. You are certainly ultimately responsible for your outcomes and will have to provide information. But in having an expert who does it all the time, interact with the tax office on my behalf, I get to avoid making inadvertent mistakes that can create a lot of hassle. And from personal experience, I can tell you it is a lot of hassle, so don't do it. There's a second reason to use a tax agent, I think, and that is because you want someone else to your earlier point, ask questions of and get expertise from. Simple returns, maybe you can deal with. The tax law in Australia is some of the most complex on earth. I have a full-time job doing other stuff. I also have a family and friends and everything else. Can I keep up to date with all the legislation? Not a shot. So I have an expert on my team, on my 6-star team, whose job it is to be up to date on tax. And so we can have a dialogue, and a dialogue with an expert or experts in your team is going to improve your decision making and improve your outcomes. And we're talking about large sums of money.
Yeah.
So that's why I would have a tax agent if anyone's asking.
Well, you don't want to get it wrong with the ATO, do you? I mean,
no,
they're not nice to deal with when you get it
they're
wrong.
not particularly friendly. No, the penalties are rather extreme. It's the one sort of place where you are proven guilty, and you're guilty until proven innocent, which is absurd. That's not the way Western law works, except tax law. So yeah, you definitely don't want to get it wrong with those guys. Curiously, and this is really interesting, they know more about what you've earned and what you've spent than you do when you prepare your return.
That's interesting.
Now, they don't know necessarily some of the expenses and all of the little things that fall into property, which is why a tax agent is useful to share that information with the tax office. But broadly speaking, when they come asking you questions, they already know the answers. They have the best data matching in the country. And so if they're asking you a question, they know the answer before they ask. So be very careful how you answer.
Gosh, I mean, that's really tricky behavior, isn't it? It sounds to me, and I hope the tax office don't watch this, but sounds to me almost like entrapment. Like, I mean, it is quite phenomenal how intense it can be with the ATO sometimes.
So everything is now reported to the tax office largely.
Yeah.
Anything that goes through a bank account is reported to the ATO. Payroll, superannuation, all reported to the ATO. One touch, payroll, all of that sort of stuff. So basically, they do see everything.
Yeah.
The exception a little bit is property, because some of that is still a little bit manual, right? There's rents coming into a real estate agent. The real estate agent or the managing agent is reporting. So there's ins and outs over there. They haven't quite got all that stuff down completely. If you do not have a property and you're simply earning money and working from home, they pretty much know everything except how many hours you spend at home versus the office. And there have been calls from taxpayers to say, well, why doesn't the ATO do the return for us and simply send it out for signing? Because they've got everything. For someone who doesn't have property, that's almost possible, is how much information they have. I don't know whether you want to call it entrapment or not. Certainly,
no, I'm not calling it entrapment.
A high degree of transparency and honesty would be recommended with the tax office. There aren't tax dodgers so much anymore, unless you are, I want to say unless. I would guess that there are extremely large companies who work offshore and extremely wealthy people who have arrangements so complex, the ATO takes a while to pierce through them. But for the people we're talking to today, they've got the info.
Yeah. Oh, gosh, that's fascinating. Yeah, I do remember an incident where a team member back in the day, a long time ago, and this is going back quite a way, must be going back 10 years, had got themselves in a pickle with the ATO. They had a largish debt. It would under 100 grand. We're probably talking somewhere between 20 to 50. And the ATO at the time made no bones, or this is how the person spoke to me about it, that they were being told they needed to sell their only investment property to pay that debt. And there were other options, and she did get help and support and some guidance, and a payment plan was worked out, and she didn't have to. But if she didn't have that help and guidance, for all intents and purposes, she may have sold an asset that she didn't need to sell. And she was beside herself. It was a really tough time. And, obviously, if you get yourself in a bit of a pickle with the ATO, there's going to be some repercussions. But I just remember, because initially she didn't have that advice, she didn't know any better. It was a tough road until she got some guidance and then was able to navigate it. But it was like coming up against a brick wall for her initially.
Yeah, this is without a doubt another reason to have a good tax agent, an accountant for you. There will be occasions where tax debts erode, or maybe there's been a gain. One of the core benefits every property investor can take advantage of is a tax agent can delay your return for longer than you can yourself.
Yeah.
The taxes are due October, basically comes to the end. We're all supposed to be done. If you have an accountant, that can be pushed into next calendar year, which can be beneficial. If you do have a tax debt, you have the option of negotiating with the ATO, depending on what their enforcement situation is in any given year. That can be worked out, or it can be a little tougher.
Yeah.
But if you've got a tax agent, they can get you on a tax payment plan. Some of the penalties that might normally be enforced, you can sometimes have waived. That's certainly occurred within the sort of family grouping I've got. There was a delayed tax return, and the tax office wanted $1,000 for that. And my wonderful business partner and tax agent, Daniel, got that one fee waived. So there's benefits that I enjoy. Obviously, we try and get this all done on time, but when it does get a bit tough, I'm not going to give them the right information about the right outcome. I'll let you sort.
Yeah, it's kind of like, I guess having a good accountant or having a good team behind you is like having your barristers in court, isn't it? You wouldn't self-represent in court, or not many of us would.
They don't have a good history of outcomes, I think, is the key thing that comes from that. There's a reason we have a 6-star team, and it works really well together. You have multiple people all giving their perspective. Hopefully you're not sitting in the middle having to make the decision, the concept of family office type arrangement where your experts can talk under privacy, etc., and help you come to the best optimal decision making is something that I've seen leveraged again and again with the Positive Group, and I love it. Better choices, better outcomes, and tax is a really, really key point. We've seen, folks get to the end of the year, and this is actually recent, coming out of COVID with high interest rates and everything else. Clients are like, I have to sell a property to hold, and they go and contract for sale, and they do that near the end of the year, and they end up with a big, stiff capital gains tax bill that comes through. There are things that you can do with that. It's not that you can't pay the taxes, but the capital gain is income to you in that tax year. If you have other tax deductible expenses because you've talked to your accountant before you've signed the contract, there are tax deductible expenses. You can prepay a year's worth of interest on another property. You could prepay 12 months of property management on another property. You could send some money to superannuation and claim the tax deduction. It's about effectively legally managing tax affairs. Most clients don't have all of this stuff at the top of their heads, but a good accountant will, and you just need to ask.
Yeah, and that can make a massive difference between what you actually get to keep and what the
$30,000
ATO
in
takes.
tax. It was a saving that one client made last year, which is really nice. So keep it in your pocket, keep it in your investment by effectively managing income and expenses in a tax year. And this is where clients, there's some good kind of guidelines. If you haven't worked with an accountant before, I've got a sort of hit list of minimum things that you want to set as expectations with someone you're engaging.
Cool. Shoot from the top.
Yeah, sure. So if you're going to go and talk to an accountant, you should know what you're going to pay more or less in advance. There shouldn't be any surprises. Yes, there'll be an odd up or down based on extra work that comes out, but you should kind of get a quote on engagement in advance for a fee that's either a not to exceed or a pretty firm number so that you know what you're up for. In the same way, you should get some indication of what services you're going to get. A tax return is probably one of them, right? That'd be the minimum. But what else are you getting for the money you pay? As a bare minimum, you want to get a meeting with your accountant at least a quarter before the end of the year or in the early part of the last quarter of the financial year. So if you do have things like capital gains or other one-offs to deal with, expenses can be organized, things can be done. It's too late once the financial year is over. You can't sort out any, largely you're stuck. Whatever is there is there. And if there's optimization that can be done, it has to be done while the year is open. I don't know if I mentioned this. I don't want to get to the end of the year and get money back from the tax office. If I'm doing it that way, I'm doing it wrong. It's not correct. It's great to get a check from the tax office, and they still, in some cases, send checks, believe it or not, maybe on the basis that you won't bank them. I don't know. Anyway.
Excuse me, I'm not crying for your advice. I got hay fever. It's got right in my throat. But I wanted to really highlight, I got my water here. I wanted to really highlight that because I think that's so, so important. Because I, for one, have always looked at it. I quite like getting a tax refund, but I haven't had one for years. And so I've always thought, oh, poor old me. But you are absolutely right. So I just want to say that again for everyone. We want the ATO to be waiting for our money, not the other way around. Yeah.
Correct. If you get to the end of the tax year and you're getting money back from them, you've got your tax affairs organized the wrong way. They'll hold your money. They hold it in escrow, I guess. It's yours. They'll give it back. They're not going to pay you interest.
No.
Right. And meanwhile, while they're holding your money and not paying you interest, you've got a loan that you are paying interest on, and it's quite serious levels now.
Yeah.
So when I get to the end of the tax year, to be clear, and I think this is good advice for anyone who's managing tax affairs well, I want to get a bill.
Yeah.
I want to get a tax bill. I don't want to get there and no one owes anything. I want to owe them some money, because if I do it the right way with a tax agent, I don't owe them interest either. And for some period of time, I don't want a big tax bill, let's be clear, but for some period of time, I've had their money in my offset saving me interest, and I pay it back after the fact when they come and ask for it. And I'm quite happy to give it to them.
Yep.
I think that's the best way to do it.
Yep. 100%.
Sounds weird, but seriously, think about it.
You're 100% right. And it's always what, Robert Kiyosaki, all those guys say, use other people's money, like pay yourself first. It's all of those principles, isn't it? That you're just
don't use the tax office money inappropriately, because they will penalize you dramatically. But if you're doing all the right things, right, and you've had a good year and you've had maybe you've sold something and you do owe some capital gains tax, you can delay your taxes with the tax agent and pay that tax later. I mean, that's all appropriate. So use the tax legislation to your favor.
Yeah.
Don't stiff the tax guy, because they'll stiff you back. But
no tax avoidance.
Hold on to a little bit of money for a while. It's all good.
Yeah, no tax avoidance, just legal tax minimization.
No, don't do that. We're not suggesting that at all.
Fantastic. All right. What else? Anything else?
I'm looking down through my list of things. And we talked about simplicity for sure. I guess
one
of the things I'd suggest when you do go and ask questions of an accountant. I do believe you have the right approach. You should not be giving them, apart from low taxes, you don't demand from them the outcomes that you want because they are the experts. So ask a lot of
100%.
questions first.
Yeah.
If you get a lot of answers back and you don't understand them, I would suggest caution. Yes, there's expertise. Yes, the tax law is obscure and somewhat tough, but how a tax agent or an accountant manages your affairs, you should be able to understand it fairly well. If they can't explain it to you,
Yeah. It's a
that's
problem.
kind of a bit of a red flag, right?
Yeah.
So listen to what they're coming up with answers. And again, the KISS principle works rather well. Keep it simple.
Yeah.
There is a bit of an incentive to over entity yourself because, of course, accountants do get paid for every return they do, and every entity you create will potentially have to complete a tax return. There's a time for them, but make sure you understand clearly the benefits and do ask about the downsides because there are some dramatic ones, loss of deduction,
Yep.
so forth can be one, loss of depreciation can be another. There's all sorts of issues that do come up. So you need to look at kind of the pros and cons of how you hold things in two places and make sure you weigh up those things effectively in partnership with your tax agent when you're asking good questions.
Yeah, no, I really like that. And I think it's important because it's the same principle, that KISS principle, keep it simple, stupid. It's that thing that applies to investing as well. And I've always said to all my clients over the years, like, if it's overly complex, then there's probably a problem. Like, the thing I like about property investing, and I share this quite openly, I failed maths at school. And I say that not because I'm stupid, but because I just, the school system didn't suit me and I just tuned out. And I wasn't interested in maths at the time. I came from an artistic family. And much to my mother's, she was so frustrated with me. But I always think if I can grasp property investing without passing school maths and succeed at property investing and do really, really well out of it, it doesn't have to be complex. And I look around at the times that it is made complex, and usually it's either hiding something, it's like, look over here, not over here, or there's going to be a trade-off. You're usually doing something complex like, like NDIS, and there's a place for all these things like options, like, all that trickier stuff. But it doesn't necessarily have to be that complex to get a great result. And
Can I give you my wrap up mathematically? Sorry.
Oh, please.
Of property investment, because this is why this is the simplest way I think about it. In Australia, I have the ability to go and buy property because we're moving a lot of people into the country who've got nowhere to live. And I can get gross yield, capital gain plus income, somewhere around 9, 10, or 11%. Whatever. Maybe it's not as good, it's 8. Well, I don't know, whatever. And to do that, I go see my broker. I want to come back to this point later when we talk about complexity. I go see my broker. He goes to the bank and he gets me someone else's money at 5 or 6% to buy that property. Okay. Got something growing at 10, using someone else's money at 5 and 6. There's some expenses.
Yep.
But the tax office is going to give me back a third of everything I spend and incent my investment program in the meantime. I'm going to do that every day until I can't borrow any more money. Because
100%.
why wouldn't you? It's absurd not to. This is not financial advice. Go see your experts before you take a financial advisor. So do not act on this without talking to.
We don't know your personal circumstances.
But that's it in a nutshell. It's dead simple. And the broker's kind of a little bit of key. Very, very tactical, immediate role. But here's a way to actually test what's coming from your accountant. If there are entities coming in, if there's someone's talking about SMSFs or discretionary trusts or unit trusts or whatever it is, go see a broker and say, can it borrow money?
Yeah, it's so true.
And
Yep.
if it can't, there's no point doing it. So
No.
ask them not only can they borrow money, but how hard is it to borrow money?
Mhm.
Because it's quite hard.
Yeah. Yeah. I mean, we got down to with our properties in the hybrid trust, we got down to one lender that would do it. And then and we actually moved those properties on in the end, but and only fairly recently. But if we had tried to refinance them today in today's market, there would not have been a lender that would do them.
That's right. I mean, if you go to an SMSF, which is a fairly common and very effective way, done correctly, to invest, you're down to a pool of, 10 or less banks. If you go and buy personally, you've got the full swathe of, 120, 130 organizations.
Yeah.
The key point, I guess, coming out of all this is property investment on an
Give yourself that flexibility.
is heavily incentivized because of the tax benefits and the tax rates we have individually, which are quite high. The fact that the banks are all set up to just not just give you money anymore. It's not quite as easy as it used to be, but largely the easiest way to get money is as an individual.
Yeah.
That's the key to investing. Right. Can't pay tax on an investment if you can't buy it.
Well, then this is true. And the thing is that for most people, to create that $100,000 income, you need around 2 million, 2.5 million in debt-free property. And if you can't get into the market to borrow in the first place because you make stuff so complex, because learn from my mistakes, folks. I didn't ask good questions. I just went in and I was the expert. I was so keen to be the expert at something. And I just told my accountant. And then I found out I got a whole lot of lessons. I tell you what, I don't actually regret my lessons because I've learned from them. And I've learned hard. And some of those lessons have stuck so well with me. And maybe if I was told them, I wouldn't have learnt them in the same way. However,
we're not going to learn from anyone else. It seems humans aren't good at that. We certainly learn our own lessons. Let's hope they're not terminal or too.
Well, 100%. And you don't want to be still learning them when you get to your 50s. I learned these in my 20s.
Learn them early, learn them well, move on, because investment is about time and leverage.
It is.
I've got another thought on the sort of tax agent thing. And I was thinking about this in relation to brokers too. We tend to sort of think of these experts who help us as maybe not employees, but, you pay for something, you get something. And I'm almost think that that's the wrong way to approach it. They're not employees. They're not service providers. They're not even necessarily, they are supposed to be professionals, obviously.
Yes, of course.
But I think the relationship I've got with my 6-star team members is more of a business partner. You're in the business of property investing. No, their money's not heavily involved, but it's dependent on your success because, that's how they draw an income as well. So think about your accountant and your broker really as you need to trust them. You need to share, I guess, intimate financial details with them to get anywhere, right? So they're going to know a lot about you. These are the sort of people you should be able to pick up the phone to and, depending on how busy they are, get a reasonable engagement with rather than just it's not a factual exchange. This is how much you can borrow. This is the tax you get back. That's not where the real power comes. The power comes in the dialogue, the questions, learning obviously that goes on. But I think it's much more of a partnership to get really outstanding results than it is service provision.
Yeah. And so more of that, that you use the word dialogue, the conversation and the troubleshooting, the problem solving.
I think early on there's more of a sort of in the journey, there's more of a reliance on their expertise. But don't ever look up to them as being perfect because they're certainly not. They will make mistakes. So you've got to get good at asking questions and making this more of a peer engagement. sort of as quickly as you can, because in the end, you're going to hold the property. In the end, you're going to hold the loan. In the end, you're going to be accountable for the taxes. If you overly rely on a professional and don't have an engagement that allows you to sort of query, check, do whatever, it can be a bit expensive. That's another lesson.
Yeah. Okay, awesome. Well, good tips. And for people that are looking for the tax professional and the relationship with a 6-star team member, how do people find you in your team?
Well, it's quite easy. If you are a positive client, your coach can put you in contact with us, which is very, very straightforward. There is a Positive Tax Solutions, long URL, positivetaxsolutions.com.au website, and you can provide very little information there and engage with us. And we'd love to hear from you. We have designed a program. It's sort of the 80-20 rule. We don't do complex companies, returns and all of that sort of stuff. We've literally hired staff to focus on the bulk of the clients we see coming through, which is individual investors, mostly on payroll, some self-employed, who hold properties in their own name. They might have a few deductions related to work. They might have work from home deductions, a lot of property and depreciation and interest deductions. And we've literally hired our staff and set up our systems to deal with those clients first. We offer a flat price, and it's really mostly based on, is it an individual or a couple? So how many returns are we doing? How many people are we dealing with? And then how many properties have you got? And it's been really well accepted. We are very busy, of course, right now, but we're getting
room for more.
Yes. So if you'd like a tax agent, I have a good one. He's my tax agent, so I'm somewhat subjective here. He's done some great work for me with his staff, and so Daniel and the team will be happy to help others like they help me.
Awesome. And I'm putting you on the spot here, and I don't, only because I don't know the answer. What about SMSFs and that kind of thing? So people interested in finding out about self-managed super, is that something you guys are doing at the moment?
We are. So that's split into two parts. If you have a self-managed super fund, one of the services we offer is a flat rate fee for managing the affairs of your self-managed super fund.
So audit and everything.
Audits, bookkeeping, registered office, all of those details. So that's a service that is there that we can help you with.
Love it.
If clients are interested in establishing, that's now falls under an Australian financial services license, and you must talk to an accountant or a financial advisor who has one of those. And if you're interested in going there, I'll suggest this. Whoever you talk to, doesn't have to be me, ask them to show you the math. Investing in a self-managed super fund is a little bit different than doing it yourself. The tax rates are lower, so the deductions are less. The interest is commercial and it's higher, so the numbers are not necessarily quite as good. You don't want to leverage up. You want to buy something that churns out cash, and a good advisor will show you what that looks like and how you, for the trouble you go to, and the fact that you have to deal with the ATO, who's the regulator for SMSFs, which is always fun. How you can have an outsized outcome compared to staying with, some industry funds that basically can't hide anymore. They have to provide good performance, and that's the comparison. So make sure you've got an advisor who shows you the math, and seek that first, and they can help you get that all up and running. And then
because it's not for everyone.
Take care of the bookkeeping and the paperwork.
Yeah.
So both services are here. Come reach out. We'll have a chat.
Sounds good, because I know I get a lot of questions from clients about self-managed super, and there are a few things that you need to be aware of, and one of those is definitely the amount of cash that you're going to put into it, because like Ant said, if the numbers don't stack up, then there can be of little benefit to you. It's not getting a property in your super for the sake of doing it. It's got to be engineered so that you can get that debt down in your super really quickly. And the most sensible way of doing that is leveraging low. So it's the opposite of when you're out in the in your own name, where you choose often to leverage high initially. when it comes to super, we're generally leveraging quite low to really boost your cash flow so we can get that debt down.
We've run over those numbers individually. The analogy I've got is, property investing is normally like in your own name. It's like driving a car. You don't need a lot of licensing. You go get some experts, you get a couple of lessons, off you go. And if you have a bingle in your car, you've got insurance, you make a claim, probably not too terminal. It's pretty safe.
Yeah.
Good all time.
Yeah.
An SMSF is more like driving a Formula One car.
Ah, very nice.
Goes really fast when you get it up into seventh gear and it's just churning out cash because the tax rate's so low. It just gets you ahead so fast, delivers your goal so quickly. It's brilliant. But you need a special license to drive it. And if you just go and get in it without thought, you can do a James Dean into a tree, which is very painful. You might not survive it, and the SMSF might get shut down. The penalties if you get it wrong with the ATO are extreme.
Big.
You just want to avoid it. Leverage is a bad thing in an SMSF. Just generally, again, general rules, not giving you advice. But if you're paying now 8 or 9%, some of my clients in SMSFs have on their loans, that's kind of getting close to where your gross return is on your property.
100%.
And the tax office is only giving you 15% of that loan interest back an eighth. It starts to make wealth a whole lot slower. So it's like taking your supercar with a loan, putting it in first gear on a rutted road, throwing an anchor out the back and trying to go for a really quick drive in your Formula One car. It just doesn't work. It's really painful, rocky, and you can actually watch your super go sideways or go backwards. I've seen that. That's weird. Possible. Don't recommend it for clients. So go see a professional, and done well. Oh, it's brilliant. Brilliant. So yeah. I love it.
Fantastic. All right. And so I'll ask that classic podcast question for you. Putting you on the spot again right now. I'm enjoying this today. I've got you in the hot seat. It's like having you in the hot seat. So if you could go back in time and you could sit with young Ant, going back that 36 years, what advice would you give to young Ant based on what you know today?
Well, young Ant was an idiot. So there's lots of advice.
We're all idiots when we're young, aren't we?
Yeah, oh my God.
Look at my maths result.
What a waste of a good body and a young brain, right? Anyway, the advice I'd have for young Ant would be to find my 6-star team early and to engage them. Cost-effective 6-star team and start early. I'm trying to do this with my son, who's in the process of buying the second investment property at age 21.
That's amazing.
Time and leverage, and I do the math for clients all the time. 20-year projections, where are you going to be? If you start when you're 20 instead of when you're 40 or 50, or you start at 40 or 50 instead of 60, time works. Time creates wealth. And so you start as young as possible. If you've got kids, you help them get started. I'm not going guarantor on kids' loans. I'm not doing any of that stuff. But if I can give them enough to get them across the line, that's being a dad and being good. I didn't have a dad to help with that. I didn't understand financials at all because I didn't find them for you or your kids, the financial experts. Surround them with a pool of people who have their best interests at heart.
Yeah.
Start. Don't wait. Start. Yeah. If you haven't yet bought, why?
Yeah.
If you haven't yet invested, why? You can't save yourself wealth. If you put money in a bank account, it'll grow at 3%. Inflation's running at 7%. Your buying power's going down. Why are you doing that? That's nuts. We can get into a whole bunch of stuff here. Start early, start with the team early, and get cracking would be the things that I think that's the most profound thing that you can tell. Someone who's young. Yeah.
I look at some of our young guns that are part of the coaching teams and so forth, like Hayley as an example, not yet 30 and she's got 5 or 6 properties. Like, your son even though he's not part of the positive real estate team, he is kind of by definition. Yeah, he's related, part of the family. That's amazing. I know Jason and Shay's son, Callum D's son, has got a property under contract. And it's so good to see such young people making such big headway.
It's for the exception of the rule. And here's maybe the sad thing. There are people like us who are willing to help young folks with our team. So giving them the right advice, yes, it must be done. You've got to connect them.
Yeah.
Having them listen.
Oh, yes. Well, that is true.
I'm not sure if I had have talked to the younger me, I would have paid any attention because, of course, life was going to last forever and I was bulletproof. But you've got to take a shot at it. And if you take a shot at it and they don't listen, then you've got to figure out another way of communicating. Are you the right person to be doing the communication? Should someone else they look up to be doing it instead of you? I won't talk too much about my son because I don't want to embarrass him. It's lovely that he has a girlfriend who's teaching him the things that he needs to do right, because I don't need to take that role on anymore.
Oh, that's amazing.
The incentives are working much better.
Oh,
I don't know what they are.
That's so cool. And I think I'll just add one thing to that before we do wrap. And it's what I've observed, and this may not sit right with some people, so I apologize in advance. It's only my opinion, but what I've observed is people that give their kids the opportunity that they never had, in way of, I'm giving my kid this property, or I'm giving my kid this whole deposit, or I'm giving my kid, and there's nothing in it that the child has to put any graft in for. I think we run the risk of doing them a disservice, because if you haven't struggled for something, or you haven't aimed and striven, what's the right word there? You know what I mean? I did pass English.
This is an extremely important point.
If
you do it for them, give it to them, you basically cripple them. It's like cutting off someone's limb. There's 100%. Nothing to it. They don't understand anything. They don't understand the value of it. They're not going to look after it.
Nope.
I think providing assistance, guidance, advice, contacts, is things that add 100%. Immense value.
100%.
If you do it for them, you're going to be looking after them forever. And that is so bad. I mean, bird nest, you can't fly for the little bird, right? Out you go. You're going to fly, you're not going to fly. Not suggesting we go that far, but that analogy maybe works a little bit. They've got to do it themselves.
It's how you build self-esteem, right?
And ask for help. I think that's brilliant. So there's a balance. I'm not sure we all get right. But giving property is a bad idea, I suspect.
Yeah. I know people often come at it from the best place. They just want to give their children opportunities they didn't have. And
we drive kids to school, and, no one walks or takes the bus anymore because it's too dangerous, or whatever it is. At some point, we need to let the kids figure it out.
Yeah.
And there's some more stories there. I won't get too much because we've probably talked out the tax time. But it's
awesome.
Let's wrap on tax.
Okay.
Really passionate about it. I want you guys to think about this. There's tax games in Australia, and we're heavily incented to invest. The tax game's pretty awful. You're paying the game of 25 or 30%. Anything you earn, if you do it well, that's what you're going to lose, a third or an eighth. The game's different in super. We can talk about that another time. It's the game of 15% tax, an eighth or zero. Come talk to me about that. That's awesome. But that's a very, very big, stiff bill you're getting stung with. And you want to strip out of that anything you don't legally have to pay. And you're going to find a good tax agent to do it for you, because giving up a third or a quarter or more if you're a doctor on payroll, find a tax agent, make the rule, make the game better.
Yeah. Have it work for you. It's that old adage. Awesome. Well, thank you, Ant. I think we could have had a glass of wine and kept talking. We can take over from Jason and Andy on wealth, wine, and wisdom.
Oh, look, I'm here. We can talk about property investment or financial advice, whatever you guys want to have a chat about.
Oh, fantastic.
There's lots of good
Awesome.
stories, and they probably come out better with wine.
I reckon they will. Awesome. Well, thank you so much once again, Ant. That was short notice, and I appreciate it, but I thought it was important that people know. Yep. Yep. No. Awesome. All right. That's it for now. Thanks. Bye for now. Bye. Hey, thanks for listening to Property Investor Tales. Remember to subscribe so you get notified every time a new episode drops. As you can guess, I love hearing people's property investor tales. So if you'd like to share yours, then please get in touch with me via email at propertyinvestortales@positivementor.com.au. We would also love your feedback, and I would appreciate a 5-star review over on Apple Podcasts or Spotify. Remember, you can watch all of these podcasts over on YouTube at Positive Mentor or at positivementor.com.au. Until then, take care, happy investing, and bye for now.